Should you trade in your AT&T stock for Verizon stock? I'm sure this thought has crossed some AT&T shareholders' minds now that the news of the upcoming dividend cut has sunk in. Let's dig into this question and both companies to find out which option may be better for you. Welcome to Longacres Finance, where the mission is to seek out the best high-quality dividend stocks for safe, reliable, and growing dividend income and a strong total return. If that is your goal as well, join the community and subscribe to the channel. For a long time, AT&T was the dividend giant among the telecom giants, with a dividend yield of 6 to 7% or more. When Ma Bell finalizes the sale of Warner Media to Discovery, that high dividend yield will be cut approximately in half. The future quarterly payout of 28 cents per share would place AT&T around a 4% dividend yield, which in today's market is still a very attractive dividend yield. The dividend cut is obviously a huge negative aspect of the upcoming changes to AT&T. But let's for a moment take a look at the positive aspects of the Discover deal. First and foremost, this deal will immensely improve AT&T's fundamentals. AT&T has been burdened by an enormous amount of debt. The debt load recently climbed to more than $150 billion. Selling Warner Media for $43 billion could potentially cut the debt load by about 30%, giving AT&T some much-needed breathing room. It is very difficult to grow a business if a significant portion of your cash flow goes towards paying dividends and debt payments. Which brings us to the second positive aspect. Future possibilities. Unless you have been hiding under a rock, you must be aware that 5G is the hottest telecom topic today. The FCC began auctioning the 5G spectrum to telecoms earlier this year. AT&T walked away with 28.5% of the 5,684 licenses for a cool $23.4 billion. 5G will be one of the primary drivers of growth for this industry in the upcoming years, and AT&T needs to invest heavily into this technology to remain competitive and grow in the future. $43 billion in cash and a smaller dividend burden will go a long way to help AT&T invest more into 5G. In fact, AT&T CEO John Stankey said that rather paying a 5% dividend yield today, he'd rather invest in something that can return 18 or 19% and generate value and growth. Perhaps he was referring to 5G. Let's take a look at the bear case for AT&T. Going back to John Stankey's comment about 18 or 19% growth, can AT&T actually hit that growth rate? I think the answer is no, at least not anytime soon. If we look at AT&T's core business segments, there is little to no growth in the recent past. The best area of growth for AT&T has actually been Warner Media. Quarter 1 revenues were up 9.8% for this business segment year over year. In fact, Warner Media has been the growth engine for AT&T. And now that it will be sold, AT&T will need to find growth elsewhere. 5G is the obvious place to look, but I think it will take time to see those results. The other elephant in the room is the dividend cut. Dividend investors hate dividend cuts, and I think for those that have sold their positions in the stock, it's game over for AT&T. It might take a while for AT&T to regain investor trust, more so from the dividend community. Historically, companies that have cut their dividend did not have the best performance in the near future. Shares of AT&T have been going nowhere for the better part of the last 10 years. The biggest driver for shareholders was that attractive 7% dividend yield. Parking your money in an asset that saw little capital appreciation but paid you a 7% cash flow wasn't too bad. But doing the same thing at 4% is not attractive at all. Let's take a look at one of my favorite dividend news sources to see where they see AT&T right now. The premium quant algorithm from Seeking Alpha judges AT&T as neutral right now. This predictive algorithm parses dozens of metrics and assigns a stock a letter grade for 5 different factors. Let's dig in and see how AT&T ranks for each factor. The highest ranking for the stock comes from the profitability factor, where AT&T earns an A+, primarily because their profit margins are higher than the industry median. AT&T has seen a number of analysts raise their earnings expectations, giving the company a B- grade in the revisions factor. The value factor is an A, primarily due to the share price pullback following the Warner Media news, bringing AT&T to historically low prices. This goes hand in hand with the D grade for momentum, as the stock has significantly underperformed against other telecoms recently. Finally, and maybe most importantly, AT&T receives a grade of F for growth, implying the algorithm shows that not only has AT&T had below average growth in the past, it also doesn't expect much improvement in the future. To sum it all up, AT&T is looking to shed some debt, streamline, and focus on their core competencies. There are plans for future growth, but I think overall, the stock is a risky bet for anyone hoping to beat the market with this former dividend giant. If you believe in AT&T and are willing to take the risk, I hope AT&T does prevail and offers strong returns going forward. I would also love to see them amp up the dividend growth and rebuild their dividend yield in the coming years. But the future isn't clear for this telecom. So how does Verizon measure up against AT&T? And more importantly, does it present a better investment opportunity going forward? In terms of dividend yield, the two companies will be in about the same place. Verizon may get the slight edge here, with about 0.5% more in yield. Verizon is making a similar move as AT&T, minus the dividend cut of course. The company is offloading its Yahoo and AOL media business segments for about $4 billion. They will retain a portion of those segments that saw strong growth while under Verizon's leadership. Verizon had an impressive first quarter this year, beating sales and earnings expectations, and saw their revenues grow at 4.1%, well ahead of AT&T. The company far outspent AT&T when it came to the January 5G auction, buying 62% of the available licenses for $53 billion. If you recall, AT&T picked up just 28.5% of the licenses. Even though picking up more 5G licenses may appear better, it does come with a cost. For one, Verizon heavily increased its debt load to fund this expenditure. Additionally, this opportunity will also carry a higher implementation price tag. The company projects to spend around $10 billion over the next few years around its 5G investments. And while total revenues grew year over year, Verizon saw a net loss of 178,000 phone subscribers in Q1 of this year alone. The added debt, the loss of subscribers, and the projected future expenses may weigh down on future returns. So the question is whether growth from the core segments and 5G will be more than enough to offset losses and higher expenses. And I think it may be so. Verizon is betting heavily on 5G, and there is a good chance that bet will pay off. Let's see how Verizon ranks in the premium quant algorithm on Seeking Alpha. Overall, the quant rating ranks Verizon as neutral to bullish. For profitability, Verizon scores an A+, with very strong profit margins. Analysts have also raised their earnings estimates for Verizon, earning them a B- in the revisions factor. For momentum, Verizon earns a D, primarily due to the poor one-year return for the stock, in comparison to the telecom sector. Verizon shares appreciated about 4% during the past year, while the sector on average grew 10 times faster. This earns Verizon a B+ value grade, because while their financials have grown, that growth has not been reflected in the share price, suggesting the stock may be trading for a bargain price today. The company hasn't kept up with average growth for the sector, leading to a poor growth grade of D-, and future growth looks to be more consistent, although it may still be below sector average. To recap, both companies look to be trading for attractive valuations today, but may not offer market-beating growth in the future. Verizon appears to be a better 5G play at the moment, and may be the better short-term play. Much of AT&T's future will depend on how the restructuring plays out, and whether the company can invest in the right areas. As a current shareholder, there is no immediate concern to jump ship from AT&T, but Verizon looks to be the safer telecom play as of right now. All in all, there are better opportunities out there for strong dividend yield or dividend growth investors right now. If you're looking for dividend investment ideas, make sure to check out my high yield and high growth monthly watch lists. Let me know which stock you like more, AT&T or Verizon. Thank you for watching, don't forget to subscribe, and see you next time.